Good morning, everyone, and thank you for joining today's webinar. My name is Anthony Cohen, and I'm from CQG Singapore. So today I'm going to talk about the behavior of various technical indicators and how they behave in volatile markets. Volatility can be a tricky concept. And as we're about to see, we're going to find out why it is so important. Well, simply because traders tend to use technical indicators to make trading decisions or build algorithms. And the dynamics of markets during volatile times are very different than usual in normal times. So the ranges will be far greater than usual, and therefore the trading psychology will be different. Stops and profit-taking orders are placed differently. Some participants will just not participate, which will have an effect on liquidity. And some participants will close their positions faster than usual. So as we can see here on a WTI chart, this is represented on two separate occasions. And let me just remove this.
はい、野上です。はい。はい、はい、はい、はい。はい、大丈夫ですね。はい、はい。すいません。おはようございます。よろしくお願いします。はい。はい。それでもうつないでますけれども。
Hang on a second, we've got it. Okay, sorry. So as you can see on the WTI chart, this is represented on two separate occasions. What we see here is the total volume for the contract in question in light blue, and the tick volume below that in pink, which represents the number of contracts, not the number of contracts, but the number of transactions. So regardless of how many lots are traded, this is simply the number of transactions. And below that, we'll have the ratio of the two. So this is to show that in general, you would have traders place relatively large size orders, but that when volatility strikes, like in those two cases, the trade sizes drop considerably, like we can see here. So in February 2022, we dropped to a ratio of about 2.78 lots on average per order. And we've seen a slight increase to about 4 lots again in the recent days. So that's to show that this the volatility has different impacts on the structure of the markets. On these two charts, we see a similar scenario, and we can see this starting at the beginning of COVID in 2020. So this is the mini Nasdaq and the micro Nasdaq. I wanted to add the micro just to see and to show you that the drop in volume in the big or the bigger of the Nasdaqs on these two isn't explained by traders moving from one contract to a smaller size contract, because we can see that the volume itself is actually increasing, but it's actually the size of the orders. So it's the number of transactions that's increasing as well. So the size of the orders is going down. All this means that certain tools will not necessarily work as expected anymore, and that a different set of tools is going to be needed for traders to avoid getting caught on the wrong side of the market. Volatility comes from in different flavors. First, we have historical volatility, which measures the volatility of the underlying instrument based on the standard deviation of its own historical data. And then we have implied volatility, which is the amount of volatility assumed by the market. So rather than using a simple standard deviation-based formula like historical volatility, implied volatility plugs several variables, such as option prices, underlying price, strike price, and expiration date to compute the volatility. Compared to historical volatility, implied volatility is more forward-looking and can be used to assess what's to come. Now, the importance of monitoring volatility is that it has a large impact on other indicators calculation. And one of the key characteristics of it is that it has a memory aspect. So let's take a look at the chart of the Dow Jones in one of its most critical periods. We can differentiate the two, not just because of the amplitude of the move, but because of the memory aspect of it. And we'll see what that means. So between October 1987 and part of 1988, we can see the daily net changes were still very high and decreasing over time. In the second example here, however, we see that there's a very swift down move followed by a very swift up move in subsequent days. But then after that, the levels are back to normal. So we can't really talk about volatility in this case because the move isn't really sustained over time. And this is what it means that the market remembers that we're going back to normal levels and that the volatility has not really affected anything. This is really just an isolated case. And this is also important because it means that traders don't really have to change strategy just because of that move. It's really just a one-off. Let's take a look at some of the most common indicators used by traders. The RSI, or Relative Strength Index, is one of the many momentum indicators. It is bounded, meaning that it oscillates between 0 and 100 due to the nature of its calculation. The market interpretation of its values is that below 20 or 25, it is considered oversold, and above 75 or 80, it's considered overbought. We can clearly see that the spikes in February have sent the indicator into overbought levels. However, after the retracement towards the 50 level, the indicator struggles to continue towards oversold levels, and it remains above 30. On the WTI example, back in February 2020, when the market was in clear sell-off mode, the move is so sustained that at the first occasion it finds, it'll pull back, like we can see here. Another effect of volatility is gaps. And gaps are frequent at the open on intraday charts, mostly after the weekend. But as we saw in the last 2 months, it has happened on quite a few occasions throughout the week. And they'll cause distortion of the indicator, which will require the indicator some time to catch up again. This causes a complete reversal of the indicator's value, like we can see here, which almost switches from overbought to oversold scenario. And however, the problem is that the market after that did not follow the same direction. So this has a huge impact. Divergence occurs when an indicator reading is pointing in one direction, but the underlying is going the other way. So in normal times, divergence can be interesting, but in volatile markets, we can see that both intraday and higher time frames, this can be quite problematic. On the mini S&P daily, we can see a magnificent example of a market clearly going down right when COVID started. But the RSI is showing quite the opposite. Now on the 5-minute charts here, we can see the similar scenario. And this is happening due to the fact that the strong move is pushing the value to a lower boundary, and we can see that the RSI flattens towards 0. So any move on the other direction, so going back up on the price, will have a huge effect on the RSI. MACD is more of a trend following indicator, which is the differential between two moving averages. Unlike the RSI, it is not bounded. But what we see here is that the market swings will cause it to cross and uncross more often than usual. It's also subjected to the same gapping issue as the RSI, like we can see here. Although they're calculated differently, stochastics will face the same kind of issues since there is a moving average component in their calculation. This means that there's an added lag, and that any strong move in opposite directions will cause a crossover of the indicator. The users will tend to change the period of the indicator to counteract this, but it's a tricky process because you never know when to switch back. One of the alternatives is to use indicators which have a component that is specific to today's activity in the calculation, rather than a period-based study, which is likely to gap up or down at the open, like we just saw. So the idea is that once you have established that there will be volatility, if you know that extremes can be reached throughout the day, you can try to identify extreme levels, either at the open or during the session. So of course, these are usually used in conjunction with other indicators, but at least they give you a better reading of the market's dynamics. And of course, this is not investment advice, but this is really just to show how things behave. So indicators that are more likely to provide a certain degree of extremes identification are, for example, the range deviation pivots by Sean Downey. Compared to traditional pivot points, they adapt better to the situation since they're centered around the opening price. And that avoids having a whole trading day outside of the levels that the normal pivot points would provide. An example here on the Nasdaq 100. So of course, with the exception of a couple of days where the extremes are breached, but I wanted to include that. You can see that the indicator provides a good source of potential levels throughout the day, like these. Here on wheat, I wanted to show you the days leading up to the spikes in February when the conflict in Ukraine started, where there were clear, strong deviations. However, we can still see that the level definition is respected, like here. And lastly, an example on WTI for the same period and similar results. We also have VWAP, or volume weighted average price, which is another tool that can be used, although we use it with a slight difference. Here we use multiple deviations around the original VWAP indicator, which does tend to follow the price quite nicely throughout the day, but also catastrophic situations where swift moves occur. Once again, since the VWAP is based off the data from the start of the day or the session, can change, we have better levels to work with. An example here on the WTI is to have an idea of the accuracy of it. We can compare it with the Bollinger Band below. And we can see that the VWAP will adapt much better to the strong moves and provide a more dynamic level throughout the day, even though both indicators are actually based on standard deviation. On gold, here we can also see that sometimes we have multiple occurrences where the price meets the indicator perfectly. And this would obviously be, need to be used in conjunction with other indicators, but this helps you quantify the moves throughout the day. Lastly, we can also derive higher timeframes for this indicator, just so that we're not limited to an intraday trading indicator. Here we have an example of the daily time frame on wheat, and we can see that an interesting reading back in February and March when the volatility was extremely high. The highs on those days were still within the upper bands of our indicator, and therefore provided very interesting boundaries. So this concludes this presentation, and I'd like to thank you for your time today. And if you have any questions, you can just contact our team in Japan or myself. Thank you.